Everyone, welcome back. A major event today. RBI reduced the repo rate after 5 long years. Yes, it was expected. However, looking at the US Fed, some people had a little doubt. Also, immediately after the rate cut announcement earlier in the day, the expectations was that the markets will zoom. However, the outcome was not same. This left a lot of people confused how to read the fine print. In this video, we'll talk about what is the impact or the real impact of the current rate cut. We'll specially talk about the impact on senior citizens or anyone who depends on their livelihood on small savings like fixed deposit. Then we'll talk about the perceived impact on corporates, companies, businesses. This move is expected to help revive the economy to a very large extent. And then we'll talk about consumption for retail. Will this move lead to higher consumption? And finally, we'll discuss about the possible cushioning impact of things like crypto, gold, silver, which have been. Let's start with the event itself, repo rate cut, what that means. So RBI has many measures to control liquidity, interest rates and inflation in the general economy. Some of them are CRR, SLR and repo rate. Last time we saw CRR getting cut and that was really liked by banks. What that does is it puts extra money with the banks. That is without raising any new money. But right now we are not talking about CRR. This was last time. This time what has happened is a cut in repo rate. Repo rate is a rate at which RBI lends to banks. This is a short-term measure to inject liquidity. Suppose banks really need money, they are not able to raise money from the market or they need more than what they are able to raise. They go to RBI and say, give us some money. RBI says, give me 6.5% and I'll lend it to you. Meanwhile, you go and hunt for money and return my money back, say in 1 month, 2 months time. Does it have a huge impact? Yes, if banks are out of money or they really need money, it does help them because the cost of borrowing from RBI goes down by 25 basis points. Does it impact a lot? I am a little doubtful and let's talk about it in the remaining part of the video. Let's talk specifically about impacts on banks first. So banks in India still are dependent a lot on what is called saving bank and fixed deposit. What that means is if you have money lying in your saving bank account idle, you get about 3%, maybe 2.5%. On the saving account balance, not deposit, the deposits would typically start say around 4%, 5%. Depending upon the tenure, this could go up to 7% also. In certain banks, especially small finance bank, this could be as high as 9% or even more. Mostly senior citizens get anywhere between 0.25 to 0.5% extra in most banks. Now, if you see the economy of last few years, banks have struggled to raise money from the markets. The stock markets have been going up like anything ever since the pandemic ended. The pandemic fall ended and bonds also have become more popular. RBI itself has done a lot in making bonds useful and more affordable. And as of now, people have not seen bond default. So most people say, why get lesser interest from fixed deposits? So if interest rates are going down, then why would people have extra incentive to keep the money in banks? They were already a bit reluctant to keep their money in saving banks. Even fixed deposits are a little discouraged right now with people who are young, who have a risk appetite. They say, I'll take risk. I'll put money in the long term in equity market. That's because SEBI itself is partnering with so many AMCs in giving these ads that markets are fine in the longer run. Mutual funds. And this is just the starting. For now, I believe interest rates may have peaked. And that brings me to the second and probably one of the most important points of this conversation. The impact of this move, which is reduction in interest rates via CRR reduction, eventually leading to reduction in interest rates on fixed deposits and saving accounts. How does that impact small savings, specifically senior citizens, maybe housewives and early retirees who are dependent upon fixed deposit returns? I'll talk specifically about 2 points. One is FD interest and second is inflation. See, fixed deposit interest, suppose a senior citizen is getting, just for argument's sake right now, 8%. In 6 months time, starting probably tomorrow, you might see some announcements on Friday night itself, maybe on Saturday, that these will go down to 7.75%. Now impact will not be same across the board. So if you think of a senior citizen who has say 1 lakh rupees in deposits, then this amounts to as of now 8,000 rupees approximately speaking cash flow per year. This will reduce to 7750, a 250 rupees drop. Now if this corpus was 10 lakh, then this drop will be 2500. Now for argument's sake, we will say that inflation also has gone down. Think of it, if your expense per month was say 10,000 rupees and the inflation was 8%. At the end of 1 year, this expense became 10,800 because of the 8% inflation. Now suppose next year the inflation goes down from 8% to 5%, which is good. So this 5% is not on this 10,000 expense. This is on 10,800 expense. If this inflation was zero, then also you will spend 10,800, not 10,000. Inflation is not going back. That is called deflation. So at 5% inflation, this would probably be 11,000, say 200 or something like that. Suppose you needed 10,000 rupees, you were getting it from the fixed deposit, and now you need 11,200, but fixed deposit returns will go down. Will that make you at par, richer or poorer? So people who are dependent upon small savings, historical inflation and historical high interest rates will lead to lesser money in the hand to spend after adjusting for inflation. And here I'm not even talking about taxation. So if you are a senior citizen or if you are dependent upon FDs and if you have liquidity in hand, the best time to do FD probably in the next 4 or 5 years is now. I don't expect interest rates to crash by say 1.5-2%, but this may be the highest interest rate we might see for next few years, at least 4 or 5 years. One suggestion or my learning in life is that don't go for 1 or 2 year fixed deposits. The interest rate will be at least 50 basis points or 0.5% higher here. This is what most banks do. They invite you to just make a deposit for 1 year or 2 year. The interest rates for 5 years will be at least 0.5% less. But that interest rate will remain for 5 years. Next year, once your 0.5% more FD comes up for renewal, the interest rates may have fallen 1.5%. The next beneficiary of this move, which is interest rate reduction, is on corporates, companies, factories who have to raise money. It could be for expansion or it could be for working capital. So we'll talk about two impacts: cost of money, which is the interest rate at which you raise money. The second is cost of goods sold. So for example, Britannia, if they are selling biscuits, then the cost of biscuits to retail. The cost of money has been high, but again, it has not been very high. Interest rates this time have not gone through the roof. And a lot of corporates, especially the capex hungry ones, they have gone to something called QIP. QIP is very interesting because that is raising money, say from United States of America, where people are more than happy to give you a loan at say 5%, 5.5%. If you go to the balance sheets of Adani Group, their cost of borrowing or cost of money is one of the lowest. They are really smart at raising money. Now this puts a pressure on banks. Why? It's because the lending rate, which is the percentage banks charges from corporates, is higher, say 14%. If this 14% people are going to US and raising for 5%, the highest interest earner for bank is gone. So while government is encouraging QIP because that temporarily at least is bringing in dollars because rupee is depreciating, this is not that great for banks. If CRR leads to reduction in interest rates, then the cost of money for the companies will go down. But say this 14% will become 13%. Not everyone goes for QIP. Not everyone has the ability or the need. But the people who are borrowing from outside, why would they go for 0.5% less when they can borrow at 5% from US? One more route for companies has been bonds. Now NBFC bonds right now are selling say at 11%, 12%. That is still lesser than what banks charge the corporates. Banks will have to get competitive when it comes to lending out to companies. The balance sheet right now are clear. The NPAs are in control, both gross NPA, which is GNPA, and net NPA, which is NNPA. So not just CRR related 0.5%, the overall spread, which is the cost at which they lend, which is say 14%, and the cost at which they borrow, say 7%. This difference has to go down to make a material difference. I don't think anyone is waiting for capex to happen, wasting years of their progress because of a 25 to 50 basis points reduction in interest rates. Now, when it comes to cost of goods sold, this entire benefit of interest rate cut, this 25 basis points, maybe in future 50 basis points, that will add to the bottom line of the company. No benefit will be passed to the customer except for banks. And if you are a home loan owner, you can double check that your interest will go down by 0.10%, 0.15% only, not this entire 0.25%. State lenders are different. Government may ask them to reduce by a full 0.25%. That is why if you go and check, maybe the public lenders, the public banks, their stock markets may be a little lesser over the next few coming days compared to private banks. This is not a usual trend. I'm just saying because most state lenders might have to give a higher benefit to customers right now compared to private banks. When it comes to consumption companies, for example, Britannia, Varun Beverages, HUL, I don't expect a penny worth of discount or reduction in price going to the customer. If you are a stock market investor, you can expect higher OPM, slightly higher. But if you are a consumer, no benefit is expected in my opinion. The cost once up in this country, they don't come down. The most important factor, consumption in the context of retail, you and me. Let's talk about what influences consumption. The first one is need. If you need something, for example, if you need detergent, you need to buy it. Even if economy is not that good, even if the job part is a little dicey, you won't stop washing clothes. You will need toothpaste. You will need to pay electricity bills. You will need a mobile phone. You will need internet. That consumption usually is not impacted that much. People may downgrade a bit maybe if they are really not able to afford. The second factor is spare money. If you have spare money, then yes, you can go and buy iPhones, you can buy a car, you can go on a holiday. But if you are not having spare money, your reserves, you will curb consumption, especially the discretionary one. For example, if you bought an iPhone 2 years back, you don't have to necessarily upgrade it this year. Confidence, you might have money, but if your company is not doing well, if you are expecting, for example, layoffs, or in general, if you are seeing stock markets tank, FD rates reducing, which brings down your confidence in the economy as well as in your own future, your family's future, whether you'll have enough abundant money or not. That is where reserves count. If you aspire to buy, say, a bike, you will try and buy a bike. You will try and buy on loan and EMIs maybe. Homes, for some, it is a big aspiration, but it is discretionary. By the way, I'm of the camp which says that you should own ultimately the house you live in. Not necessarily at the age of 25 or 30, but yes, when you can afford it. At this juncture, if economy does not improve, it goes sideways or it is slightly down, then home is discretionary and that discretion may not change by 25 basis points cut. The bigger problem for most people is the down payment, say of 20%, 25% most of the time because homes have become really costly. So home sales may remain a little under the cover or tepid. I'm talking about normal homes, the high-end homes like the DLF ones, 190 200 crores, they will sell like hotcakes in any economy. The normal homes may have lesser buyers, especially in resale. People may still go for houses under construction where they don't have to pay the entire amount now. Maybe where the EMI start after 2 years. Vehicles, again discretionary unless they are very cheap in size. Even if someone has to buy, say, a car, they may go for a slightly cheaper mid-sized or smaller car than they would have done probably an year or 2 year back when economy was really good. Here I'm not saying economy is very bad, I'm just saying relatively. Consumer goods, your AC is working fine, people will not upgrade the AC. If your house does not badly need a paint job, you will not go for a paint job and you will see that reflection in the stock prices in the times to come. Say for example, Asian Paints, it may go sideways, it may go down, the P may get revised. But yes, if the economy is doing fine, then these are the same stocks that will do really well. Their P's will go up, sales will go up, profit will go up. The final point, the intended good impact of CR cut, will that be cushioned by, say, stock market bull run, gold, silver, crypto? All of these asset classes till last month were on fire. Nifty is down around, say, 8 to 10%. Most mid caps are down anywhere between 20 to 40%. Small caps down 20 to 50, 60%. A lot of long-term investors will find value. So their money will continue to go in stock markets if stock markets don't rush upwards. As a result, the money available for SB and FD will continue to be low. if stock markets are not at all-time high in quick time. Gold, silver are going up like crazy. Even if people are not in stock markets, they can go and buy gold and silver, maybe physical, maybe ETFs, maybe mutual funds. SGBs are discontinued, so that is option does not exist. And gold silver, as per international economists, at least in international markets, are expected to, at least in the short term, go up a lot. The impact in Indian markets could be less or more depending upon currency rates. So gold and silver may also have a negative impact, and crypto has been spooked by something called a currency Trump, which was launched by the US president a night before he came to power. A lot of crypto money, in my opinion, is actually jumping to gold silver right now. People, if they get a chance to exit from crypto, might come out of crypto and they will have liquid cash. That cash may go to stock markets, gold, silver. I don't think people who have tasted crypto will put the money in fixed deposits. They are used to a lot faster gains and losses. If crypto confidence is restored, then money from saving bank FD will go into crypto. So this factor also is adverse for CRR cut. Banks may find it difficult to raise money from retail. A lot of things I discuss in this video are theories and my experiences. The actual things may pan out a bit differently or a lot differently. So please consult a registered investment advisor if you are making larger bets, larger investments. I am not a SEBI registered investment advisor. Thanks for watching. I will see you next time.